Well, good morning, everybody.
Good morning, David. It looks like Charlie's got a live tree in the background. You've got a fake tree in the background, and I have nothing.
Oh, it's a real tree. It's a real
is it?
tree.
Okay.
It's not a living tree, but it's a real fake tree. Let's see.
Kind of
That-
like your real fake hair.
Are you actually making fun of my hair? I mean, like that's like
I just thought I'd get you going this morning. Make sure you're awake and with it.
I just want to be clear. Like this is my son. Every now and then, I'll be like, "Dude, you're bald," and I'll be like, "Look at this. This is that's hair right there." Let's see. What should we retweet here?
I haven't looked at the market this morning. What's it doing?
And bouncing back, it's Trump made some sort of conciliatory comments regarding China, so everybody's like, "Oh, maybe he's not going to beat him up too much."
Well, also we're celebrating kind of the end of one war. So that's good.
Yep.
Hostages back. Whole bunch of criminals let go. But
The hostages back is a great thing. I wonder about the stability of the peace.
yeah, I mean, we're all of the age that know that. I think most people are of the age. You don't have to be that old to know that. Well, this is shaky at best, just given the history. But good news either way.
Yep, it is.
Well, let's see. Any other chit chat that we should have while we're retweeting here? So our producer said that it's Columbus Day and that a lot of people are out for Columbus Day.
Well, the bond market's closed. Stock market's open. Half the schools don't have classes today. My daughter's home. So, yeah, it's sort of a mixed day.
Yeah, and the big news, garbage collectors don't come around with it.
I couldn't quite hear you, Charlie. You were muffled there.
The big news is the garbage collectors don't come around today.
Oh.
Except for in the stock market. Garbage collectors are working overtime.
Interesting. I hope ours are coming because I walked out in the rain last night at midnight putting out the trash, so they'd better be coming.
Nope, David, not until tomorrow.
You don't know our trash service here in New Jersey. In fact, I have given its history. If I were you, I'd be careful about saying anything negative about the trash collection in the state of New Jersey.
I lived for 40 plus years in New Jersey, so I know the trash collectors are coming.
Actually, I saw the truck out this morning. When I went running, my trash guy was on a different street and he yelled at me from the back of the truck. So I know he was out this morning collecting garbage. So you may be in luck, David.
The truth is, the trash collectors are in this market. That's where the trash collectors are.
Well, let's see. That trash collectors could be actually a good day trading documentary title. I saw something this last week, but now day trading as a sport is actually picking up in different countries where they live stream people day trading. No joke. That's actually it.
Talking about trash, did you read about the crypto sales that were made? I mean, huge crypto sales that were made prior to Trump's China coming. You wouldn't know of any family that was heavily involved in crypto, would you? That may have gotten out before that.
No, I mean, whether or not you want to besmirch the administration that's having wins after wins after wins, go for it, Charlie. You're on the wrong. I'll just say, right color sweater, wrong place here today with us, because
I'm just curious who knew about Trump's comments.
In the famous words of DJ Khaled, all we do is win, win, win. So on that note, when I start quoting the esteemed DJ Khaled, Why don't we get going? Today is October 13th, 2025. This is Wall Street Beats. I have Bob Morris and Charlie Peabody. I'm David Maris. We're going to talk kind of what's going on with this maybe holiday. We could call it almost a holiday week because, as Bob mentioned, bond markets closed today, stock markets open. We're having a really good rebound from a disaster. And disaster, it's kind of like you gave back a couple weeks worth of return, but it felt like a disaster on Friday for everyone who's super long. But we're having a rebound today. Now, as you know, most rebounds, rebound relationships don't work out, so we'll see how this one goes. But Bob, let's talk about oil, gas, anything to make of this. Today, the talking heads were saying that, well, the peace in the Middle East is actually bringing in a new era of cooperation and economic growth in the Middle East, and it's going to bring about, essentially Dubai and in Palestine. Is that likely? Does that have anything? Does anything over the weekend have an iota of what to do with the price of oil and gas?
Oh, it does. It definitely does. I mean, one thing you're seeing is a little bit of the geopolitical premium come out of the oil price. Now, oil was down big last week just because it followed the direction of the market. When there's a trade war with China, then the global economy is impacted, which impacts demand for crude oil. So, oil here, we had talked early last week that after OPEC announced that they were going to increase production by another 137,000 barrels a day in November, that we felt that the floor for oil was $60 a barrel. Well, we dipped below 60 on Friday, and this morning we're still a little bit below, just a smidgen below $60 a barrel. But I think that's still some nervousness about how this whole deal between Trump and China and Xi plays out, and are there going to be higher tariffs? Is there going to be some sort of tug of war here, and does that impact global trade, and where do we end up on that? But at the same time, this peace deal in Israel takes some of the geopolitical premium out of the oil price. And again, you've got Trump apparently having conversations with Zelensky in Ukraine, and that may be his next step to try and negotiate a peace deal there. So, yes, there's not a big bull argument for crude oil here today. But again, I think it's going to be in this range of $60 to $70 a barrel. I think OPEC has slowed way down the pace of putting oil back into the market because they don't want to see oil collapse below $60 a barrel. But at the same time, cheap oil, cheap gas is good for the economy. As long as we can get past all this trade war talk and tit for tat on tariff and everything that's going on between the U.S. and China. So, as far as the stocks here, they're all rebounding this morning, and we're getting ready to hit in the earnings season. Natural gas has been particularly volatile over the past few weeks, running up to almost $3.50, now back down to $3.10. And right now, that's just all weather driven as people look ahead to the winter and wait for that winter natural gas demand to pick up. And if you look at the futures curve, yes, the futures are reflecting natural gas being closer to 450 come January. So how much of that is baked into the market, into the valuations? There's certainly some of that baked into the valuations, but I still think as we look at the spot price, obviously the market, and we both expect it's going to tick up quite nicely as we get into the winter. The names as far as earnings season, I know Charlie's got a big week ahead of him, but as far as the oil and gas companies, it starts with EQT next Wednesday, which I do expect them to report a good quarter and a slight beat in the quarter. And then the following week, we get the rest of the gas names. And then after that, we flow into the oil names. And so I think it's just, a little bit of peek into the quarter. I think what you will see is this continued improvement in efficiencies. On average, slight beats across the board as companies continue to get more with less equipment and see these efficiency gains or improvements continue here. So as far as the names and where we're at here, I'm sticking with what I've got. I would still look to buy any dip or pullback in the natural gas names. In fact, I did, even though I'm overweight Expand Energy, I bought a little bit more of Expand on Friday on this dip or pullback, although I wanted to get it cheaper. I went ahead and bought just a little bit more, adding to my overweight position in that name on this pullback in Friday. So, if we get a reversal in this market rebound. As you pointed out, we're rebounding a little bit. We're clawed back, what, about almost half of what, well, maybe a little bit more than half of what we gave up on Friday. Where does the market go from here? Again, it's just based on the headlines and Trump and what he does. I know the market technicians have said we sort of touched the 50-day moving average in the broader indexes on Friday, and the debate is whether that was enough to kind of justify a little bit of a almost 3% pullback, and that's enough to say, okay, we got it, now let's move on, and we're off, continue off to the races to climb higher. I don't know. I'm not a technician, but it seems that oil prices want to follow the direction in the market. But again, I don't think there's a lot of much downside to oil prices from here at just under $60 a barrel. And natural gas, I'm still very bullish on. We're just waiting for winter to pick up and make sure that we do get a winner.
I think natural gas is bottoming here. I think oil, from my trading lack of expertise, is got some downside. I think oil could see 55, so I think it will break 60. But I'm a big believer in Bob. I'm following Bob to the ends of the world, and I'm buying energy stocks every time they weaken. But Bob, the question I had for you was, there was a curious deal where the Trump administration is letting Qatar build an Air Force base in Utah. Mm-hmm. And there's obviously, the way they operate, there's a tit for tat for that. It's, by the way, to my knowledge, it's the first time a foreign country has been allowed to build a base in the United States. So how significant could Qatar be in that? I mean, obviously there's something tied to energy and their supply of energy in that agreement. I'm guessing. I shouldn't say obvious. I'm just guessing. But how big is Qatar and influential in the oil markets in terms of at the margin production?
They're not a big producer. I mean, Saudi Arabia, Iran, they're all bigger producers, bigger exporters. Qatar doesn't have, as I recall, they're not one that can they're pretty much at their capacity now. So when OPEC talks about increasing production by 137 barrels a day, there's really three countries that have the ability to put more oil into the market. So as far as energy and being a big kingpin in OPEC, they're really not a big kingpin. So, and I haven't seen the details on what all this entails and allowing them to build this Air Force base in Idaho. But I haven't seen anything yet. And maybe I missed it. I haven't found anything that has any.
According to Google AI, Qatar, otherwise known as Qatar, and you two have to decide, are we going to call it Qatar or are we going to call it Qatar? 14th globally in oil production and is the world's largest producer of liquefied natural gas.
Yes, that is true. Yeah. Although U.S. is soon going to pass them if we're not already. We're on the cusp of surpassing them as the largest LNG exporter in the world. But yes, they are.
David, I will strum my guitar while you talk about Qatar. Right.
All right. I'm not going to go down that rabbit. I'm not going to go down that rabbit hole. Yeah, my view though was the Qatar deal probably had more to do with international relations around Hamas and and getting this deal done. I don't know that obviously the three of us do not have insights into how that deal came about, but that's kind of that would have been my guess.
Timing would seem to confirm that, David. So
what's that?
The timing would seem to confirm that. You announced it on the same day you announced the peace deal between Israel and Hamas. And clearly, I think it all ties into creating stability in the Middle East and tying everybody in that you can be partners in making sure that peace is sustained.
Yeah. Well, good. Okay, so we're all set on oil and gas, and I agree. I don't know if I'd follow them to the ends of the earth, but in oil and gas, I definitely would follow 7-time number one, ranked oil and gas analyst. Anyone named number one 4 or 5 times or more is pretty much the world's greatest expert in their sector.
By the way, Charlie, the EIA is forecasting that oil Brent averages $51 a barrel next year. So there are some pretty bearish forecasts out there on oil.
EIA has been notoriously wrong, haven't they, though?
Yes.
Okay.
All righty. Well, let's Charlie, let's talk about banks. Bob mentioned that we have bank earnings coming up. Are there any names that are you still sticking with the Citibank as the cheap and performing well type of name to hold in this that you hold in this environment, or are you looking, since this couple deals were recently announced in regional banks, should we start buying PNC, or and does PNC even count as a regional bank anymore? Is it like a mini mega?
Yeah, no, PNC has national ambitions. Demchek, who is a refugee from J.P. Morgan, he worked there under Jamie Dimon, has a desire to be a national banking franchise. And they're a very well run company. They have a strong balance sheet, but they are going to be serial acquirers as they build out their national banking franchise. So the balance is, the strong earnings they're generating, are they spent in the form of dilution on building out their national banking ambitions? So I've not been a big fan of PNC. I've recommended, M&T as a conservative, low growth play, which doesn't play well in a run hot economy. But CFG, Citizens Financial, has been another regional bank pick that we have a buy rating on. And that is a leverage play on a run hot economy, and it's been one of the best performing banks year to date. Citi has been the number one best performing bank year to date. And then the one that I've sort of incrementally warmed up to is US Bancorp, symbol USB, which is more of a play on what they're going to do next year than it has been this year. And that's a show me story because they've not executed in the past, but they've got new management team. They're sensitive to their shareholder needs. They've reined in their expense disciplines. They're generating positive operating leverage. They've got good credit quality. And they're starting to show some incremental growth, which will really be visible in 2026. So those are the names I've been working with coming into the second half of this year. I will say, and I wrote this piece over Sunday night, published it Sunday night for my clients. I'll post it later today or tonight on Wall Street Beats. I am recommending the sale of the capital market stocks. So that's Goldman Sachs, Morgan Stanley, J.P. Morgan, all the secondary names in that space, like Jefferies. And so let me just talk a little bit about Jefferies.
Can I interrupt for a second? Can I ask you why, though, given with the market hitting new highs as of last week, doesn't that sound like a capital market raising time, and that's when everybody, the things are going to be the strongest? Or are you kind of trying to sell at the peak? Like hey, listen, things can't get better.
Yeah, I am trying to sell at the peak. And as you know, trying to call peaks is a fool's errand, but that's my game. So I am trying to call the peak here. But let me give you, I sort of did this on Friday, but I'll do it quickly again today. So we know that third quarter capital markets revenues are going to be phenomenal, and you're going to get beat and raise type reports from the major, capital markets banks. But during the third quarter, the capital market stocks alone were up 12 to 19% in that range, versus a 7.8% increase in the S&P 500 and a 2.9% increase in the XLF index, the broader financial index. So they way outperformed, the broader indices. So you know that some of that third quarter report is already in the stocks. And these capital market stocks trade at 3 times, tangible book. The rule of thumb used to be anytime a bank stock got to 2 times, you sold it. They trade at 14 and 15 times next year's 2026 earnings, where usually somewhere around 12 times, maybe 14 times, you would sell them. So they're richly priced for what we know is going to be very good news. So that's point number one. They've priced in the good news. The second is we're facing some liquidity and credit stresses here in the fourth quarter. So the credit stresses have been very evident. We've seen them in First Brand, we've seen them in Tricolor, we've seen them in Auto Acceptance Corp. Well, the street's going to try and tell you it's ring fenced in auto or in subprime. I sense from other reports that it's starting to move up the food chain and into student loans, into personal loans, and eventually into credit card loans. And then you're seeing it in the small and middle market business area as well. So the credit stresses that are developing here are becoming more visible as we go into year end. And then we always have seasonal liquidity strains into year end. So I think it's going to be tough for the capital markets to plow ahead in the fourth quarter with these credit and liquidity strains developing. I would just point out this past week we had two leveraged loan deals pulled. It was Mallinckrodt and Nurian, which I don't know, you might know, David. And then we've had a number of deals that have had to discount their pricing in order to get done. And MJH Life Sciences was an example just recently that had to, generate a deeper discount to get its refinancing done. So literally every day for the past 2 weeks, we've seen prices fall in the leveraged loan market. So that's the second item, is that we're starting to see credit stresses and liquidity. And I suspect, here the buy side people are better off in understanding this than I am. But if you've had a good year, are you going to take extra risk here in the fourth quarter, or are you going to take defensive actions? And if you take defensive actions, that means there's going to be less liquidity available for deals. So I'm expecting the deal flow to slow. And listen, Wall Street's never been at a loss for product to sell. They always have product to sell. It's what happens on the demand side that determines whether we have a good quarter in capital markets or not. And on the demand side, liquidity and credit are going to determine whether you want to put more money to work, as well as the threat to your bonus. If you've had a good year, you're going to take actions to preserve that bonus. Forget the client. I don't think they care about the client. They care about their own bonus. Sorry, little cynicism there. The next point is I expect that the capital markets revenues in the fourth quarter will be much less robust than the third quarter. So the third quarter is going to be close to record levels, if not record. But I think you're going to get a 10, 15% drop in fourth quarter capital markets revenue. So you'll have probably the best news you're going to get in the very short run. I'm talking about as a trader now. And part of the reason is, even if demand from the buy side comes back, you got a government shutdown. And so, the SEC in a shutdown is working with roughly 9% of their full staff. And so they're going to prioritize, enforcement actions over, reviews of S1s. So the IPO market for the month of October is probably going to be dead. And then the FTC and the DOJ are also working with skeletal staffs, and they're going to prioritize enforcement actions over Hart-Scott-Rodino reviews for M&A. So you're not going to get much M&A in the month of October. And then you look at December, and you've got a lot of holidays, and typically seasonally December is a slow month. So if I look at October being a slow month, December being a slow month, I'm looking at a dearth of deal, not a dearth, but a drop off in deal volumes in the fourth quarter. So that says short term, I'm looking at the best news here when they report earnings this week. Finally, I shouldn't say finally. The next thing is, tell me if I'm getting long-winded here, David, because I can move on. But
no, it's all right. I want to hear what's next. What's what you're? Okay. Let's turn the page and see what's next in the Charlie chapters.
So listen. Typically, when FIC as the driver of capital revenues, markets revenues, gives rise to equity and M&A as the driver. FIC being fixed income, commodities, and currencies. FICC. Fixed income, commodities, currency. When that crosses over to equity and M&A as the driver of revenues, that's the mature phase of the capital market cycle. That crossover is going to be very evident here in the third quarter when the numbers are reported. You're going to see equity and M&A as the big drivers. So that's the mature phase. Now, that does not mean it ends tomorrow. It can last for a number of quarters. But you're in the final phases of this mature of the capital markets maturing. And so the question becomes, what do you want to pay for those peak revenues? And that's going to be different for Bob versus David versus Charlie. But it typically means you're going to get distribution into strength going into the first half of next year. The next thing I would point out is, and I'm not going to get into too much detail, but we're going to probably do about $165 billion of total capital markets revenues here in the United States for the 5 big banks: Goldman Sachs, Morgan Stanley, JP Morgan, Citi, and Bank of America. That's up about 11% from last year, and last year was up 14% from 23. The 165 billion, just to put it in perspective, is a record level of revenues, more revenues than we generated in COVID, which was 155 billion. And remember, COVID was a period where we had huge injections of liquidity into the markets from the government, and we had 0% interest rates. Hard to beat a background like that. So if you go back and look at cycles, you usually get 2 years or maybe 3 years of upcycle before they peak, and then you fall off again. So 26 would be your 3rd year of an upcycle peaking. And so I think we're going to see peak revenues in 26. Again, the question comes, what do you want to pay for that, and how do you exit into that? And then the final thing is what happens with Jefferies. And that's really what I wanted to talk about this morning. But Jefferies.
Hey, by the way, what I saw over the weekend is we can absorb this, which is no banks have ever said that and then had troubles, right? Isn't that we can absorb this? That's those are famous words.
Yeah. So Jefferies, in my mind, is this cycle's Bear Stearns. Jefferies has been at the center of financing the subprime junk bond economy. And they've also financed a lot of their buyers. The products they're selling are being bought by vehicles that they finance. And so the latest exposure to this model was Point Bonita, which is owned by Leucadia Asset Management, which is owned by Jefferies. And Point Bonita was buying First Brand's receivables, so acting as a factoring agent. Jefferies was doing the underwriting of a lot of those products as well. And then there's another vehicle called Apex, which buys CLOs, which was also buying First Brand's, loans. So there's this sort of incestuous relationship between the underwriter and the asset managers that they own, Apex and Point Bonita and Leucadia being in that group. And that's what we saw at Bear Stearns back in 2007. And when Bear Stearns funds couldn't raise money to keep the balls in the air around their RMBSs, it's started run is probably too strong a word, but it started redemptions in their fund complex, which then reverted back to the strength of Bear Stearns itself. So last week, what we heard was BlackRock and Morgan Stanley asking for redemptions from Point Bonita. And when those two firms are out there with their signs saying we want redemptions, it's hard, I think, for other fiduciaries to say, no, we're going to keep our money there too.
So just to explain that a little bit further, what you're saying is that when quality banks or lenders or investors start asking for things, the due diligence departments or compliance departments at other banks go, wait, if Bank of New York wants their money back, how come we don't want our money back?
Exactly. And that's what happened at Bear Stearns. So there are gates. You can put in your request right now before December 25th, and then redemptions start December year end, December of 25. But there's 4 periods of requests, so you can't get your full money back until 2026. And so things can happen, things can change. But I think the setup is there for this thing to get worse, largely because I think First Brands is just the first cockroach within the portfolios that are in the entities that Jefferies owns, and that's going to erode confidence over time, particularly if they come quick and fast. The last thing I would just mention, on a more positive note, is Jefferies does have their investor day this Thursday, and they're going to lay out, their exposure to First Brands as being, the maximum loss of 45 million, which is a pimple on their balance sheet. But they only have $8.3 billion of capital, and they own, if you look at their balance sheet, they own about 26 billion of financial instruments that have some risk to them. So there, you get a 30% write down in that $26 billion portfolio, and you've wiped out the capital.
What do you think? What do you think the risk is? Because I lived through something similar to this, and again, I know nothing about Jefferies other than it's one of the banks that I didn't work for. But it's when during the financial crisis, one of the things that the hedge fund that I was with decided to do is, hey, listen, we don't want to be counterparty to any risk, so we're going to trade with these most, and so operationally, do you think that like hedge funds, since they drive so much of the volume, do you think that do you know of any, or are you aware of any folks saying like, look, I don't want to trade with them right now because if there is a problem, I don't want to get caught up with owning stock or owing people stock, and it can't settle very easily. Is that a risk?
David, you are a very, very smart man. That's exactly what I wrote this weekend. Is right now the risk is these redemptions from their asset management arm, but that will spill over to their trading desk. And you're absolutely right. People are going to direct their trades elsewhere. The problem that arises from that is these trading desks are heavily dependent upon flow to enhance their hedging abilities. And if you lose that liquidity of flow, it becomes much more difficult to hedge your risks. And that's exactly what I wrote about. So bravo to you for understanding that.
Well, no, again, I'll tell you, when I was at Balyasny, and Dmitry Balyasny's recognized as one of the best investors of all time, but also one of the best hedge fund managers. So he manages a complex business. One of the most brilliant things he did was during the financial crisis, he made those moves very quickly. And, that's at the expense a little bit to relationships, but, he was worried mostly about his investors and keeping their money safe. And he also eventually went to all cash way before other people. And so the reason I brought that up is that I could see where a hedge fund would say, you know what, I love you guys. I think you're a wonderful company. I think you do great things, but just from a risk standpoint, I'm gonna trade with someone else for the next month or two.
Yeah, I mean, you have a fiduciary duty to manage your risk. So I think that is on the horizon, particularly if we get another First Brand visible type situation with First Brands in the portfolios that they manage in their asset management arms. So yeah, I'm very bearish right now on the capital markets stresses and strains developing further from here. But let me just, as I said, I wanted to end on a positive note. And one is they've got their investor day. I think they'll be able to explain away, on the surface, their direct exposure as maybe the loss is 45 million, which is minimal. The second is they're going to highlight, the investments, which I think you brought up, David, a couple times ago, from their Japanese counterparty, Sumitomo Mitsui Banking Corp. I think they've taken up to a 15, maybe 20% stake. I haven't seen the final details of whether the last chunk closed. So that they've got a Japanese partner that has some deep pockets. I think I pointed out to you last time you mentioned this, David, that the Japanese have a history of investing in the United States at opportune times. I mean, didn't they buy Rockefeller Plaza or the Waldorf, or what was the golf course, Pine?
They bought the Pebble Beach.
Pebble Beach, yeah. Yeah, they bought all those things at the peak of the market, if I recall correctly. And they've been buying. I think who was it? Was it Mizuho bought Greenhill, an M&A advisor, a year or two ago. Again, just as at that time the M&A world was peaking. So I'm not sure I'm going to draw comfort from their investment, but I'm sure Jeffries on their investor day will talk about that relationship in the deep pockets that Sumitomo Mitsui has. And then they're going to review their third quarter earnings, which were fabulous. But that was, that's old news. That's looking backwards. It really is what happens to the capital markets going forward that's going to determine their future. So why don't I've been long-winded. Why don't I end it there and see?
No, it's really helpful. I will say that I want to come back as a large bank CEO. Over the weekend, I saw Jamie Dimon said that he thinks that there's a 30% chance of a correction in the next 2 years. And I said to myself, that is the lamest quote. And it's been quoted everywhere. It's like, okay, so there's a 30% chance of a correction, not defined as what a correction is, but of a correction in the next 2 years. That, I don't even know what to say to that prediction. It's the lamest prediction of the year.
Put that alongside Andrew Ross Sorkin was interviewed on 60 Minutes last night, and he said he's just finished writing his book, the 1929, and he said that there will be a crash. He just doesn't know when.
That's
awesome. Help you make money.
Thanks for that advice. Well, I mean, sure, it's no Facts Club experiment book, but it is a book that a lot of people are looking forward to. With that,
hey Charlie, one question. Didn't you say last week you bought close to the money puts on JP Morgan, and given this view that you have on the capital markets? So today I know JP's up, but would you be buying puts on Jeffries instead now, or would you still buy puts if you don't have any position in an investor looking at your view and say, well, I didn't do anything last week. What do I do now? Do I buy puts on JPM? Do I buy puts on Jeffrey? What would you suggest here?
So a couple of weeks ago, I said I had started shorting the tertiary names. Those would be the Jeffries of the world, the BDCs, right. the private equity, private capital names.
Right.
That gap between price of the tertiary names, which have already rolled over, and the primary names, which have yet to roll over, is pretty wide right now. So that's why incrementally I'm shorting the primary names, the Goldman Sachs, the Morgan Stanleys, the JP Morgans. I think they're going to be dragged down. And I mentioned, I think it was on Friday, if you look at the junk bond charts, HYG, JNK, they're rolling over. I think they broke their 50-day last Friday. If you look at the XLF, which is heavily weighted with the primary names, that broke its 50-day on Friday as well. So that's why I'm going up the food chain, because I think they're going to be dragged down with the tertiary names.
Okay.
But yeah, I have no problem pressing my shorts on some of these tertiary names like Jeffries. I just think it's going to bounce into their investor day on Thursday, so I wouldn't do it here today.
Yeah. And also, I mean, to be fair, Bear Stearns had a much higher leverage ratio than Jeffries did. So I think you're right for flagging the operational issues, like of what could happen as fallout for this, as what does that drag on? It may not be a flash bankruptcy type situation like a Bear Stearns, which is so much more highly levered, but it could be like, hey, what you're expecting for earnings might not materialize.
Well, keep in mind, Bear Stearns didn't go bankrupt. They got bought out at $2 a share by JP Morgan.
Yeah, that is technically true.
While Ace Greenberg was smoking his cigars and playing poker.
Yeah. Well. Alrighty. Well, with that, by the way, I will tell you, I was a young analyst at Bear Stearns long before they went bankrupt. And I was told to go see Ace Greenberg on the trading floor to tell him something in passing, and to tell you how much he oversaw the entire firm, the shadow that he cast. A young me was terrified. Everybody was terrified to actually talk to him. So I went down and talked to him. And you're right, he did his cigar, and he was just like a movie, like rah, 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 like barking. I had to give him something. I was like, okay, I'm out of here. This is the last I wanted to see of him I did not want him to know my name, but yeah, that was a long time ago.
When we have more time, I'll tell you my one Michael Milken story. He was brilliant, by the way. I worked at Drexel. He was brilliant.
Yeah, well, hopefully he didn't yell at you like I got yelled at. But with that, let's start off the week enjoying Columbus Day. For Charlie Peabody, Bob Morris, I'm David Maris. Catch us at passes.com/Wall Street Beats or wallstreetbeats.com. You'll get Charlie's report. You'll get Bob's musings on oil and gas, and every now and then you might get a drug stock. Have a great week, everybody.
I'd rather the drugs than the drug stock.
We don't do that yet. We don't do that. That's the next offering.